Good afternoon, class. Today I'm going to go over a couple of exercises from Chapter 7, which deals with foreign currency transactions. These exercises are to help you understand foreign exchange gains and losses that are reported on the income statement. So, exercise 7-4, Brief Incorporated had a receivable from a foreign customer that is a payable in the customer's local currency. On December 31st, 2017, Brief correctly included this receivable for 200,000 local currency units in its balance sheet at 110,000. When Brief collected the receivable on February 15, 2018, the US dollar equivalent was $120,000. In Brief's 2018 consolidated income statement, how much should it report as foreign exchange gain? So first we want to go in and identify our data. And so we have on December 31st, Brief correctly included this receivable for 200,000 local currency and reported on the balance sheet at 110,000. On February 15th, 2018, the US dollar equivalent was 120,000. So in order to compute the foreign exchange gain or loss, we're going to record. You can prepare a schedule. So when you prepare the schedule, you're going to record when the actual receivable took place. It was 110,000. Then, according to the information on February 15th, they collected 120,000 based on currency differences. So that's going to give you a foreign exchange gain of $10,000. So the answer is 2. So the 110, the original accounts receivable, and 120 when it was collected. So we're going to move to problem 7-5, dealing with the same concept of foreign exchange gain or loss in the income statement. It says on July 1st, 2017, Mifflin Company borrowed 200,000 euros from a foreign lender, evidenced by an interest-bearing note due on July 1st, 2018. The note is denominated in euros. The US dollar equivalent of the note principal is as follows. And they have a little schedule that tells us it follows the changes in the note right here. And so in its 2018 income statement, what amount should Mifflin include as foreign exchange gain or loss on the note? So here again, we prepare another schedule. Well, first let's identify data. I'm sorry. So 200,000 euros from a foreign lender. And the U.S. equivalent of the note principal is as follows. So that's this information that's in the schedule here. And so we're going to record as of July 1, 17. They had a note payable of 225,000. That's evident from the little schedule up top. On December 31st of 17, the notes payable value dropped to 220,000. So for that year, the foreign exchange gain was $5,000. Then in 18, On January 1st, 18, we know the notes payable value was $220,000. And on 7/1/18, when they paid the loan back, they paid $210,000. So that would give them a foreign exchange gain of $10,000. So the gain for 2018 is a $10,000 gain. So the answer is 3. So you need to compute the 2 separate years so you're able to tell what is the isolated gain just for 2018, because that's what they're asking you in the problem. So that's 7-5. Now we'll move to 7-7, dealing with the same concept. Matthias Corporation had the following foreign currency transactions during 2017. They purchased merchandise from a foreign supplier on January 20th for the US dollar equivalent of $60,000 and paid the invoice on April 20th at the US dollar equivalent of $50,000. On September 1st, they borrowed the US dollar equivalent of $300,000, evidenced by a note that is payable in the lender's local currency in 1 year. On December 31st, the US dollar equivalent of the principal was paid for $320,000. In Matthias's 2017 income statement, what amount should be included as a net foreign exchange gain or loss? So our data as follows. They purchased merchandise at the US dollar equivalent of $60,000. And on April 20th, they paid for $50,000. Then on September 1st, they borrowed the US dollar equivalent of $300,000 in a note, and then they paid that note for $320,000. So if we prepare our small schedule again, we look at these transactions, and so we're going to look at all the transactions for 2017 because that's what they're asking us to do. All 2017 transactions. So as of January 20th, January 20th, 17, we have accounts payable of $60,000. Then on April 20th, 17, they paid $50,000 on the payables. That resulted in a $10,000 foreign exchange gain from that transaction. Now, that was the first transaction. Now they had a second transaction where on September 1st of 17, they had a note payable for $300,000. Then on December 31st of 17, they paid their notes payable for $320,000, resulting in a foreign exchange loss of $20,000. Now to compute the net foreign exchange gain or loss, you're going to take the $10,000 and net it against the 20 for the 2 separate transactions, which is going to result in a $10,000 loss for 2017, a net foreign exchange loss. So here's your answer there. I hope that helps in following how you compute a foreign exchange gain or loss and the concept behind it.